Taimur Baig, Chief Economist Asia with Deutsche Bank, joins us live from Singapore for a quick take on Indian economy. Taimur, good morning. Thank you for joining us.
Good morning.
The governor yesterday, pretty much on expected lines, did not move. However, if I look at the fine print of the credit policy, the governor is still sounding extremely hawkish.
Absolutely. And if you look at the action that was done yesterday, the narrowing of the overnight repo window and expansion of the 7-14-day repo window, holding everything else constant, that's actually policy tightening. We estimate that's actually about a 10 basis points hike in banks' borrowing costs because the 7-14-day repo markets are clearing well above the policy repo rate of 8%. Now, moving beyond that, you're right. The tone is very hawkish. Everything that points toward a decline in inflation was dismissed as transitory, not very meaningful, and the payback might be coming soon. And everything that could conspire to push out inflation was seen in a grave light. So I think the communication of the RBI right now is clearly asymmetric. They will worry a lot about upside risk to inflation, and they will tend to look beyond the downside risk to inflation.
Taimur, what's the sense that you're getting about growth? Because that remains below potential, and there is risk of subnormal monsoon as well that we are running pretty high right now. What, according to you, would be the drivers of the FY15 GDP numbers?
Right. And even beyond the October-December national accounts data, which is the last we have for broad-level investment data, even one looks at subsequent data that has come out, whether it's from the PMI side or even some of the stuff that CMIE publishes with respect to investment plans that companies are making, it's not a pretty picture. We are seeing, at best, an economy going sideways with some characteristics of downward momentum still very much visible. If on top of all this we have a bad agriculture harvest, that's just, makes a bad situation worse. The feeling in the market, and you were discussing financial markets just before I came on, clearly is that all of this is behind us. Let's look forward. Elections will make everything wonderful. I think that there'll be a major reality check after the election, that one would have to be cognizant of the major drivers that have slowed growth down, and that will take a very long time to turn around. So for the time being, for 2014, regardless of the election outcome, regardless of financial markets performance, we have to brace ourselves for fairly poor or mediocre economic numbers.
But Taimur, let's talk about flows. And are you pleasantly surprised that Indian markets are suddenly a big recipient of global flows? In the month of March itself, you've got 22,000 crore at a time when US Fed has increased the tapering quantum.
Yeah, it's very surprising. It's good for India. You could argue that some of the hard work that has been done, particularly by the RBI, but also the Ministry of Finance, gets some credit for holding the fiscal line in the last year or so. Those hard work are paying some dividend because at this moment, investors are looking to differentiate among emerging market economies. And the economy that seems to have paid its dues, gone through a significant slowdown, addressed its external account issues, is being rewarded. So from that perspective, it makes some sense that investors are broadly constructive in India. But what we're seeing right now is beyond broadly constructive. What we're seeing right now is pure exuberance, expectations of a very favorable election outcome toward reforms and business-friendly initiatives. That's what the market is punting on. We'll see if that exuberance is rewarded or not.
Taimur, how is it that you've read into RBI's stance on increasing liquidity via the term repo window?
Well, it's not exactly an increase in liquidity in the sense that they have curtailed liquidity on the overnight side and they've increased on the 7-14-day side. The RBI has been clear since the Patel Commission report came out earlier this year that they want not the overnight but the 7-14-day market to reflect underlying liquidity conditions, and that's what they want to target. So they may have a policy rate, but the real operational will take place in the 7-14-day area. I see what they're trying to do. They don't want massive volatility to take place around the overnight borrowing window, and they want banks to take that 7-14-day money and engage in more useful transactions than just parking here and parking there. So from that perspective, it sort of makes sense why they are making this structural change. But beyond that, I don't think it's exactly a monetary policy move. It's more of a monetary policy operation adjustment.
What is the real level for the rupee? 62, 60 or sub 60?
The exporters of India would like to hold it around 60, if not a little weaker than that. After a long, long time, the rupee's weakness has been a good thing. The exporters who were struggling against competition from China, from rising domestic wage costs, saw this external adjustment take place, and that was a good thing. I think in mid-60s would be even better to some extent, given that the risk of pass-through is not that high with the existing output gap. But let's say you have a lot of inflows, as we are seeing right now, and that pushes the rupee towards 60, 61. If I were the RBI, I would use this opportunity to pick up a lot of reserves. I don't think there is anything to be gained in India with significantly below 60 rupee. It might actually end up encouraging significant additional import, which is clearly not a good thing.